Dialysis NNN properties are about as niche as NNN investing gets, but that specialization is exactly what creates one of the most important tenant retention factors in the entire category. When a dialysis center moves into a building, they spend $250,000 or more on specialized plumbing, water treatment systems, and electrical infrastructure. Relocating is not a casual decision. Here's what you need to know about DaVita NNN investing. DaVita NNN properties trade at 6% to 6.75% cap rates, wider than most of the categories we've covered, which reflects the non-investment grade credit profile. DaVita carries S&P BB Plus, one notch below investment grade. Buildings run 8,000 to 12,000 square feet on 0.75 to 1.5 acres. Entry prices range from $2.5 million to $5 million. Lease terms are 10 to 20 years, depending on the vintage, with NNN structure. DaVita operates approximately 2,700 U.S. dialysis centers and serves around 200,000 patients. They're not going away. Revenue is $12 billion annually. The core argument for DaVita NN is tenant stickiness, and it's a compelling one. End-stage renal disease requires 3 dialysis sessions per week, every week, for the rest of the patient's life. There's no discretionary component to this. Patients don't skip dialysis the way they might skip a restaurant visit during a recession. That non-discretionary demand creates highly consistent lease occupancy, and the specialized build-out, custom water treatment, reinforced plumbing, and medical-grade electrical systems makes relocating to a new facility extremely expensive. Once DaVita is in your building, they almost never leave. Florida's aging demographics are a long-term tailwind. The state has one of the highest concentrations of elderly residents in the country, and that population is the primary driver of dialysis demand. DaVita leases are NNN with 10 to 20-year initial terms depending on the vintage. Rent bumps of 5% to 10% every 5 years are typical. The specialized nature of the build-out, water supply, electrical capacity, plumbing, means the infrastructure requirements create a real tenant switching cost beyond just the lease. One important note: dialysis centers require very specific site infrastructure. Verify that the building has adequate water supply capacity and the electrical panel supports the medical equipment load before you buy. 4 things to watch with DaVita. First and most important, DaVita is non-investment grade, BB plus, one notch below investment grade. The company is financially solid, but this is materially different credit risk profile than CVS Health or AutoZone. Understand that you're accepting additional credit risk in exchange for the wider cap rate. Second, healthcare reimbursement risk is real. The vast majority of dialysis revenue comes from Medicare, and changes to Medicare reimbursement rates directly affect DaVita's economics. This has been a chronic concern in the dialysis space. Third, the specialized build-out that creates tenant stickiness also creates a releasing challenge. If DaVita ever did leave, finding a new tenant who can use a specialized dialysis center is harder than finding a new tenant for a generic retail box. Fourth, verify the water supply and specialized infrastructure before closing. Dial in specifically on those systems as part of your due diligence. A DaVita NNN is one of the more interesting risk-yield trade-offs in the NNN category. Wider cap rates, sticky tenant, non-discretionary demand. It's not right for everyone, but for investors who understand the credit nuances and want a healthcare yield play with genuine tenant retention characteristics, it's worth a serious look. I'm Ryan Solberg with MaxLife Commercial. Visit maxlifedevelopment.com or call 321-586-2121.